Well, thank you for that very nice introduction. It is a great pleasure to be here. Good after to everybody. I am very thankful to the Vancouver Board of Trade for inviting me. This is my last speech of 2024, and nowhere better to give it than here in Vancouver. Today, I will talk about delivering price stability for Canadians and how we are learning from the past and how we are preparing for the future. Along with the rest, but before I do that, I do want to say something about today's events in Ottawa. Along with the rest of the Bank of Canada's Governing Council, I want to thank Minister Freeland for her service to Canadians. It's a tough job. We look forward to working with the next Minister of Finance, continuing to promote the economic and financial well-being of Canadians. I do want to remind everyone that the Bank of Canada operates independently of the political process. We have always had strong working relationships with the Finance Minister of the day, regardless of the individual holding the position and regardless of their political affiliation. I'm not going to comment further on today's events or speculate on government policy. What I can say with confidence is that the Bank of Canada will continue to work in the service of Canadians to keep inflation low, stable, and predictable. Now, as some of you will recall, I was here in Vancouver 2 years ago in December of 2022. Inflation was close to 7%. We just raised the policy rate by 50 basis points to 4.25%, our seventh straight rate hike in our fight against inflation. And we signaled we would be considering further increases in our policy rate. Indeed, we ended up raising our policy rate 3 more times to 5%. Today, inflation is back at our 2% target. Last week, we cut our policy rate by 50 basis points to 3.25%, the 5th consecutive decrease since June. We've come a long way in 2 years. Monetary policy has worked to restore low inflation. Interest rates have come down substantially, and household spending has begun to pick up. But I'm not here to give a victory speech. Price stability is low, stable inflation. Inflation is low once again. Now we need to stabilize it around the 2% target. That's price stability. That's giving Canadians the confidence that their cost of living will not change materially year to year. Today I want to talk about delivering price stability for Canadians. I'll start with the present, where the economy is today, and what we're focused on to keep inflation close to the 2% target. Then I'll look back to learn from the past. We need to use the pandemic experience to prepare for future crises. And finally, a look ahead. The future looks more uncertain and more prone to shocks than we would all like. We need to be prepared, and that work is underway. So let's start by looking at current economic conditions. The economy grew by 1% in the third quarter, which was slower than we expected. And recent data offer a mixed picture. Consumer spending and household activity both picked up in the third quarter as lower interest rates started to boost household spending. Annual revisions also suggest the level of GDP is more than 1% higher than previously reported. However, weakness in business investment, inventories, and exports point to less momentum headed into the fourth quarter, and the labor market is still softening. Looking ahead, a number of government measures will affect the dynamics of growth and inflation. Lower immigration targets suggest GDP growth next year will be lower than we forecast in October. Other federal and provincial government policies, including the GST break on some items, one-time payments to individuals, and changes to mortgage rules, will also affect household spending and inflation in the months ahead. As always, what we'll do is we will look through the effects that are temporary and focus on underlying trends to guide our policy decisions. Inflation has been close to our target since the summer, and it was actually exactly 2% in October. and it's expected to average close to the 2% target over the next couple of years. In the October CPI data, the upward pressure on inflation from shelter and the downward pressure from goods prices both moderated largely as expected. In the next few months, the GST holiday will temporarily lower inflation, but that will be unwound once the break ends. There are risks around our inflation outlook. Elevated wage increases combined with weak productivity growth could boost inflation as businesses look to pass on higher costs. Or the economy could continue to grow below its potential, which would pull inflation down. With inflation back to 2%, we are now equally concerned with inflation coming in higher or lower than we expected. The economic outlook is also clouded by a major new uncertainty, the possibility the incoming U.S. administration will impose new tariffs on Canadian exports. No one knows how this will play out in the months ahead. With inflation back to target, the economy in excess supply, and the growth outlook softening, we cut our policy interest rate by 50 basis points in each of the last 2 decisions. Monetary policy no longer needs to be clearly in restrictive territory. We want to see growth and hiring pick up to absorb the unused capacity in the economy and keep inflation close to 2%. So that's the present. As we deal with the present, we also need to reflect on the past. And as much as we would all like to forget the dark days of the pandemic, we need to learn from that unprecedented crisis. So the Bank of Canada has been conducting a review of the policy actions we took to restore financial stability and support the economy during the pandemic. This work is nearly done, and once it's completed, we will publish our review together with an assessment by an independent panel of experts. But some of the key takeaways are already clear. Our pandemic response was effective in restoring market functioning, preventing an even worse calamity, and supporting the economy. The crisis was developing rapidly, and a quick and bold response was critical. But we can see in retrospect that when we use extraordinary tools, we need to be clear about what we're trying to achieve with those tools and under what conditions they'll no longer be needed. And perhaps most importantly, we need to remember that the actions we took were truly extraordinary. The bar to use exceptional tools has always been high in Canada, and it should remain high. These are not conventional monetary policy. We also need to take on board the lessons from the surge in inflation that followed. Why did inflation rise so rapidly, and how effectively did monetary policy respond? To be prepared for the future, we need to be clear-eyed about what surprised us. My colleagues and I have already written and spoken about some of the lessons, so I can be brief here, but I want to highlight 3. First, economic supply matters every bit as much as demand, and we need to understand it better. Monetary policy typically focuses mostly on demand, and that's because interest rates largely affect demand, and because supply usually evolves more smoothly and predictably. The pandemic reminded us we cannot take that for granted. Supply disruptions can be sudden, severe, and persistent. They can accumulate, and they are more inflationary when demand is strong. We also learned that what matters for inflation is not only the demand-supply balance for the economy as a whole, but also across different sectors. The disinflation in weak sectors may be smaller than the inflationary impact on sectors that are overheated. In the future, we need better information and analysis about the supply side of the economy. Second, we learned that price-setting behavior changes when inflation is high. You're all businesses. What we see is that typically businesses are hesitant to raise prices. They worry their price increases will stand out and they'll lose customers to their competitors. But as the economy came out of the pandemic, supply disruptions and higher commodity prices pushed up costs, and demand was very strong. Businesses had trouble keeping up with orders. With high demand, businesses felt they could pass on more of their cost increases than usual and more rapidly. What we learned is that in some contexts, businesses can dramatically change their price-setting behavior. Our economic models and forecasts need to reflect this reality. And finally, we learned, or perhaps we relearned, just how much people hate inflation. All of a sudden, people couldn't afford the things they need. And while inflation is low once again, many prices are still a lot higher than they were before the pandemic. So people feel ripped off. And that erodes public trust in our economic system. The spike in inflation in 2022 was a reminder that even though inflation was relatively low and stable for 30 years leading up to the pandemic, central banks cannot take public trust for granted. We need to earn that trust by being clear about our objectives, accountable for our actions, and humble in the face of uncertainty. That brings me to the future. Unfortunately, it looks more uncertain than it did before the pandemic. Big structural changes are already underway. Deglobalization, demographic shifts, digitalization, and decarbonization are all having significant effects on jobs, growth, and inflation. Trade protectionism and economic fragmentation are rising, and the appetite for global cooperation is waning. Shifting international relationships are adding uncertainty and costs and altering investment plans. Aging populations, changing immigration policies will also affect the supply and cost of labor. And new technologies, including AI, will disrupt existing industries and create new ones. And the impacts of climate change and the transition to low-carbon economies are becoming more pervasive. Monetary policy can't eliminate any of this uncertainty. But by keeping inflation low and stable, monetary policy can avoid making it worse. So how do we prepare? For 2025, we've set 3 priorities to help us deliver for Canadians in a more uncertain world. We need to work with our international partners to try to shape the future. Canada's G7 presidency next year is an opportunity to lead. We also need to improve our analysis, using richer information and better tools to respond to inevitable shocks. And finally, we need to ensure our monetary policy framework is fit for purpose. So let me take each of these in turn. We often focus on negative international spillovers, the harm one country's actions can have on other countries. But we can create positive spillovers when we work together. The shared resolve of major central banks to fight the post-pandemic inflation reduced the demand for global goods and took pressure off tangled supply chains. That helped us all get inflation back down without causing major recessions. In 2025, Canada hosts the G7 meetings. That gives us a chance to build on these positive spillovers. Let's face it, international cooperation is getting harder. But as shared global risks accumulate, it is more important than ever. At the top of the list is economic security. The combination of higher sovereign debt, higher long-term interest rates, and lower economic growth is making the world more vulnerable. War, geopolitical tensions, and the rising threat of protectionism are compounding these vulnerabilities. The democracies of the G7 will be stronger if we confront our shared economic security issues together. We must also confront other mutually important issues, including the risk and opportunity of AI, the potential vulnerabilities arising from non-bank financial institutions, and the need to improve cross-border payment systems. Canada can't do these things alone. Here at home, the volatility of the past several years highlights the need to sharpen our policy tools. That starts with richer information. We have invested in detailed sectoral data on global value chains. We've expanded our surveys to reach many more businesses and consumers in Canada. And we're increasingly using large micro-level data sets on prices, on jobs, on household credit to enrich our analysis. With richer information, we can build richer economic models. We've begun to work on our next generation of economic models that will incorporate the key lessons of recent years. This includes models that better capture the role of supply chains in production and the connectivity between sectors. This is going to help us understand and track how supply disruptions flow through the economy, how they affect specific sectors, and how they impact inflation. The new models will also distinguish between inflation that comes from higher demand and inflation that comes from higher input costs. And the new models will allow us to gauge the impact of changes in price-setting behavior. This should all help us understand inflation dynamics better and help us develop monetary policy playbooks that better respond to shocks. Finally, our new models will also help us manage uncertainty using alternative scenarios. We'll be able to build different scenarios with different assumptions about key inputs to the Canadian outlook, like what's the price of oil going to be, or how strong is the U.S. economy. We'll also be able to examine scenarios with different views about how the economy works. Looking at the economy through different lenses and regularly challenging our assumptions are the best ways to manage risk and uncertainty that surrounds the economic outlook. The final and critically important priority for the Bank of Canada is to review our monetary policy framework. Every 5 years, the Government of Canada and the Bank of Canada review our flexible inflation targeting framework to ensure it's the best way for us to promote the economic and financial well-being of Canadians. The joint nature of the agreement between the Government and the Bank of Canada reinforces both the democratic legitimacy of the framework and our operational independence to pursue the agreed-upon objectives. Right now, we're considering what issues to focus on. Sorry, little technical glitch. Right now, we're considering what issues to focus on in the upcoming review, reflecting on the big forces on the economy and what we're hearing from Canadians. This points to several questions. In a more volatile world, how do we identify and measure underlying inflation? Is 2% still the right target for the future? And something close to your hearts here in British Columbia, what's the interaction between housing affordability and monetary policy? I'll have more to say about the framework review in the new year once the work truly begins. More than ever, Canadians are aware of economic issues and the work we do at the Bank of Canada, and they are reaching out to share their views. We welcome this. Bring it on. And we will continue to seek out diverse perspectives as we undertake our framework review. We want the best monetary policy framework for the future, to fight the next battle, not the last one. Il est temps de conclure. Les chocs seront plus présents dans le monde de demain. On espère que des incertitudes clés seront levées. Ce n'est pas sûr, mais on peut se préparer. Maintenant que l'inflation est revenue à 2%, on est mieux placé pour réagir. On veut garder l'inflation proche de la cible. C'est la garantie de la stabilité des prix pour les Canadiens et les Canadiennes. As we look ahead, the world looks more shock-prone. We hope some of the major uncertainties hanging over the world will be resolved. We can't count on that, but we can prepare. With inflation back to the 2% target, we are in a better position to respond to whatever may come. We want to keep inflation close to the target. That's delivering price stability for Canadians. We have reduced the policy rate substantially since June, and those cuts are working their way through the economy. Going forward, we will be evaluating the need for further reductions in the policy rate, one decision at a time. In other words, we anticipate a more gradual approach to monetary policy if the economy evolves broadly as expected. Our decisions will be guided by incoming information and our assessment of the implications for the inflation outlook. Even as we manage the present, we are preparing for the future. That means working with our international partners. It means making sure monetary policy is a source of stability, not further uncertainty. And it means taking on board the lessons of the pandemic and its aftermath, tapping new data sources, and building our capacity to better manage uncertainty. Over the next year and a half, we will also be reviewing our monetary policy framework. We are committed to being transparent and accountable in everything we do. That starts with listening. We're visiting more communities across the country. We're also doing more to explain our decisions. I hold a press conference now after each decision to answer the media's questions, and this is followed by a written summary of our monetary policy deliberations. The bank has added an external deputy governor to provide a fresh perspective, and we are currently recruiting for a second deputy governor, so send me your CVs. We're also finding new ways to reach Canadians through new communications products and platforms. We will continue to look for ways to be more transparent and accountable. We want to earn the public's trust, and we are. Increasingly, households and businesses expect inflation to be low. And as that confidence in low inflation has come back, so has trust in the Bank of Canada. Our surveys show Canadians better understand our role, and they see us as working to serve their best interest. That's encouraging. We are intent on rewarding that trust by delivering low and stable inflation, by learning the lessons of the past, and by being the central bank that Canadians can rely on now and in the future. Thank you very much.
Thank you very much, Governor. I think the engagement and the discussion right now will be focused on addressing the volatility and uncertainty that many businesses are facing and the risks and the opportunities in the year ahead. So I would like to call on our moderator for the question and answer period with the Governor. Please welcome on stage Darren Dahl. Darren is the Dean and Innovate BC Professor at the Sauder School of Business, University of British Columbia. He is a celebrated teacher and researcher in the fields of creativity, social influence, and consumer behavior. And as they are settling in, a reminder, you can submit your questions on slido.com. Darren, I'll hand it over to you.
Thank you. First off, I want to say welcome to Vancouver, and thank you so much for your remarks. Amazing. I think we'll get started. I know that we'll have questions popping up here very shortly, but in listening to your remarks, you hinted at a few things that I thought would be fun just to get a little more insight on. The first is the notion of our target of inflation, 2%. And we've been steadfast. That's been the marker for quite some time. You gave us a brief hint in your remarks, questioning, is that the right target? And, we do have a range. We talk about the 1 to 3. But as we move forward, is that something you want to question a bit more? Is there more that you can give us on whether this is where we're going to stick on inflation?
Well, the first thing I want to underline is that I think one of the strengths of our inflation targeting framework is that we do review it every 5 years. And I think when inflation was 8%, I'll be honest, a lot of people were like, really? You want to get it all the way back to 2? Like, why don't we just get it partway back? And I really stress, it's like, look, when you have a target, we'll put it this way: if you don't go back to your target, you don't really have a target. And the target is what really has anchored the system. We've demonstrated we can get inflation all the way back to 2%. It is 2%. We're now really focused on keeping it there. But we do periodically review our framework. And one of the questions people are asking is 2% really the right target for the future? And the way that question often comes is, and it relates to a number of the things I talked about. You look forward, you're all running businesses. You're seeing it. There are more cost pressures coming. You're having to make your supply chains more resilient. You have to build in resiliency. You're dealing with new investments in greening the economy, in decarbonizing your operations. Trade is getting diverted. Economies are becoming more fragmented. You have to think about economic security issues as you make your investment decisions, not just simply the lowest cost solution. So those things are going to create new cost pressures. So some people are saying, well, maybe we should just raise the inflation target. I will admit I'm not convinced. But I do think we have to have an open mind. We have to ask that question. And let's convince let's make sure that we are convinced the 2% is the right target. I'm not convinced because I think adding more inflation will just add more uncertainty. I mean, those pressures are real. You're going to have to deal with those as businesses. Creating some more inflation uncertainty isn't going to make that any easier. I think it'll make it harder. But as I said, I think one of the strengths of our system is we have to go in with this with an open mind and ask some tough questions. As we get the answers, that will assure us we do have the best system for Canada.
Okay, fair. Right out of the gate, and it's not going to surprise you, our number one question does focus on this notion of tariff and what we see south of the border. I like the question because it frames it as, what is the scenario planning approach? So it goes a little deeper than just, what's your opinion on Trump, which, might be exciting to hear. But I think the crowd also interested in how are you approaching that in terms of your scenario planning?
Well, look, I mean, we're doing scenarios. I imagine every one of you are running a business, you're probably doing your own scenarios. For monetary policy, look, a big increase in tariffs is a very difficult shock. I mean, let me just start out by saying a change in tariffs on the scale that's being suggested would be highly disruptive for the Canadian economy. It would actually also be very disruptive for the U.S. economy. Analyzing the situation from a macroeconomic point of view, it really depends exactly, okay, what is the tariff? What is it applied to? What exemptions are there? Does Canada retaliate? All those things matter a lot for the economic impact. So yes, we are doing scenarios. In fact, we've published some of them when in the previous Trump administration, we saw some tariffs. We did some scenarios, and actually, if you want to go back and look at, there's one in the July 2019 Monetary Policy Report. Interestingly, it's a 25% increase in tariffs. It wasn't just for Canada; it was for everyone. I think what that highlights is there is a lot of uncertainty in the effects, but we do have economic models. We can work through the channels. So we're doing scenarios. We can't run monetary policy on something that might happen. We talk to businesses. It's pretty clear that the uncertainty. If you're considering an investment decision, you're probably waiting until there's a little more clarity about what's going to happen here. So it's the threat of tariffs is probably already having some impact on the investment climate here in Canada. If they do get put in place, it will have a much bigger impact. We will certainly have to take that on board for monetary policy, and you're going to have to think about, how do you deal with it in your operations.
Right. So obviously a potential challenge. The next question I think that's quite interesting is, that macro question of, what are the other major challenges that Canada is going to face? If we put you on the spot and said, think of the 1, 2, or 3, major things that we need to be thinking about as business leaders, where are the challenges going to come from? What would you say?
Well, it's no secret we put productivity very high on the list. Yeah. One thing I think that puzzles me a little bit is you look at the Canadian economy, you look across the Canadian economy, almost every sector, we have a world-beating company that is competing really effectively in global markets, that's growing, that's investing, that's developing talent, that's exporting, and it's winning in global markets. But when you look at our productivity numbers, while we have very successful companies in every sector, we just don't seem to have enough of them because our average productivity growth is really quite weak. So it's not as if we can't do it. We can do it. The question is, what is holding us back from doing more of it? I think there are some what I've called own goals. I think there's some things we do to ourselves, interprovincial trade barriers, long regulatory approvals that businesses hate uncertainty. Regulations are in place for good reason, but when it simply takes too long, business capital goes elsewhere. So I think there are some things we've done to ourselves. I think there are some deeper structural issues that won't get fixed quickly. But I mean, our view is, look, we need a more concerted focus on productivity. And why do we focus so much on productivity? Well, productivity is what pays higher wages. Productivity is what increases standards of living. Productivity is what makes your businesses more competitive, grows your bottom line. And for monetary policy, what productivity means is the economy can grow faster without creating inflationary pressure, because we're getting more output with the same inputs. So we're not creating inflationary pressure. So productivity just solves a lot of problems. Our view is we need a more concerted focus.
So if we follow up on that, and there's actually a couple questions just popping, so you've keyed in on something that clearly is important to the room. What can the Bank of Canada do or encourage or at least support with respect to this notion of productivity? Like, how can we as institution, have an impact?
Well, unfortunately, the Bank of Canada actually can't do that much. It's actually the business community that creates productivity. It's not the Bank of Canada. I mean, what does the Bank of Canada do? The way I would put it is, we create some fundamental kind of background conditions that businesses need to thrive. So low stable inflation, low predictable inflation. You can have more confidence that your costs are not going to be changing rapidly. Financial stability. We are not Canada's prudential regulator. That's the Office of the Superintendent of Financial Institutions. But we do work with OSFI and the Department of Finance. And what we tend to focus on are what are systemic risks to the system. So we use our macro financial expertise to identify what are big systemic risks. So, what is this? Well, housing has been, we've got high household debt in this country. That is a vulnerability. How do we manage that so it doesn't turn into a bigger problem? And hopefully by creating more stability, more predictably, that creates an environment where you can focus on the things that you need to focus on to grow your business, grow your economy. So the Bank of Canada's role in here is quite indirect. I think the other thing we can do and do is productivity growth is very critical input into how we see the economy growing, because as I said, more productivity growth, the faster the economy can grow without creating inflation. So that's something we're always trying to assess. So we do a fair amount of research on and analysis on productivity, and we talk about it, we publish it, and hopefully that helps.
Okay. You see the top of the leaderboard here. Cryptocurrency won't go away. It's clearly something that's on people's mind. Opinions, thoughts on the future of cryptocurrency here in Canada?
You know what? I really don't have much on this one for you. I may be biased, but I kind of like our Canadian banknotes. I'm a big believer in the Canadian dollar. You won't be surprised. And whether you hold that in physical cash or whether you hold it digitally in your bank account. Look, I think Canada having its own currency that allows us to run a monetary policy that is geared to Canada. Mm-hmm. Look, Bitcoin, my opinion, it's a speculative asset. If you want to buy it, buy it. If you don't. That's we don't give investment advice.
Perfect. But we can shift because of your love of Canadian dollar. Obviously, we're looking at a weaker Canadian dollar. How does that impact your interest rate decision process? How does that factor in to the? And I think that's a more pertinent question that might be on your mind.
Sure. Yes, the Canadian dollar has weakened. When we did our outlook in October, it was around 73 cents. It's been about 70.5 the last few days. So it's down about 2.5 cents. So a couple things. First of all, we don't target the value of the Canadian dollar. It is determined in markets. What we target is the inflation rate. And we use our policy interest rate to try to keep inflation close to 2%. And the interest differential with the United States is one thing that affects the exchange rate. Mm-hmm. I would suggest it's probably not the most important thing. If you look at the depreciation of the Canadian dollar since October, most of it reflects the fact that the U.S. dollar has been appreciating against virtually every other currency globally. So the weakness of the Canadian dollar is really more reflection of the strength of the U.S. dollar. If you look at the Canadian dollar across other crosses, so other major currencies, it's actually been relatively stable. But look, I have no doubt we've lowered our policy interest rate in Canada much more than the Federal Reserve has in the U.S. We'll see what they do later this week. And that really reflects different economic conditions. Inflation has come down more quickly in Canada. The Canadian economy is weaker. We need a policy rate that is weaker in Canada. And because we have our own Canadian dollar and we have a flexible exchange rate, we can run monetary policy for the needs in Canada. But then, yes, as you suggested, the other side of that is, well, a lower Canadian dollar will have some impact. It actually makes your exports more competitive in the United States. So that should increase demand for our exports, which contributes to demand in the economy. It also means that things that we buy. So if you are buying machinery equipment from the United States, unfortunately, it will be more expensive. Right. When we're all going to buy fruits and vegetables through the winter from the United States. If the Canadian dollar is weaker, they will be more expensive. So that is something that we need to take into account as we set monetary policy.
Okay. Competitive advantage. That's another question that seems to be in many people's mind here. Where do we need to bolster? What do we need to think about as we look at increased competition with respect to global instability that we're seeing as headwinds coming forward? How can we think about the Canada advantage?
Okay, well, that's a really big question and probably a whole other speech. But let me touch on a couple of things. I think you start by playing to your strengths. You start by doubling down on what you're really good at. I think our education system has been a huge strength in this currency. I'm talking to a dean of a business school, a former dean of a business school to a current dean of a business school. So maybe that doesn't surprise you. But
a lot of deans.
Look, I think our education system has been a huge advantage. And I mean, I can certainly tell you, when I was dean of the business school, companies were coming to Canada, and they're coming because they wanted to hire Canadian talent. So I think that is a big strength, and I think the education system is under some pressure. It is going to be important that we build on our strengths and we don't take them for granted. We actually have a wonderfully diversified economy. We've got a very strong natural resource sector. We have an important manufacturing sector. We have a growing service sector. Our tech sector, I'm here in Vancouver. Your tech sector has grown considerably in recent years. So, that diversity, I think, is another strength, and I think we want to work to preserve the strength in different parts of our economy. There is strength in diversity. This is clearly under threat at the moment, but Canada actually has, with the trade agreement with the United States, with the Trans-Pacific Partnership, with the CETA trade agreement with the European Union, Canada actually has among the best trade access in the world. That is under threat. That is a big uncertainty for us. And there's going to have to be an all-hands-on-deck approach to doing whatever we can to preserve that market access. But that, again, is a big advantage for Canada.
Perfect. Just a few questions left. You did highlight in some of your remarks the notion of housing affordability, its impact on inflation. And obviously that's something very central here in Vancouver, often on people's mind, everything from, individually affording housing to, how do we recruit great talent when housing becomes a barrier. So when you think about housing in general for Canada and monetary policy, what intersection do you see there, if any?
Well, look, to state the obvious, we don't do housing policy at the Bank of Canada. We do monetary policy. But we are very aware that the housing sector is among the most interest-sensitive parts of the economy. So when we lower interest rates, one of the first places you tend to see it is you tend to see a pickup in housing activity, and that's what we're seeing. We've been lowering interest rates since June. You can see housing activities picked up. In fact, there's some new data out this morning. Housing starts were quite strong. And the government's announced some new mortgage rules. Those kick in basically as we speak. So, the combination of lower interest rates, some new mortgage rules, we are expecting to see some pick up in housing. That's not going to solve the housing affordability problem, though.
Right.
I mean, what's going to solve the housing affordability problem is not lower interest rates. It's not higher interest rates. We've tried both. It's more supply. If you want to get more people in houses, we need to build more houses. And I think too long we focused too much on demand. I am very pleased to see in the last few years there is much more focus at all levels of government on supply. I think that is going to help. I don't think there's a quick fix solution here. It takes time to build houses. It's going to take time to get supply up. That's really that's what's need to be done to address affordability.
Okay. One last quick question for me on your remarks, and you spoke specifically of the review in terms of pandemic and 3 strong lessons that came out of that. What was surprising to you, though? What did you not expect? Has anything come out of that review, that process, that caused you to pause and say, okay, that one I didn't see? Or was it all predictable?
Well, I think I think the major lesson is, one of the extraordinary tools we used our balance sheet in a very big way. And what we did is we bought a lot of government bonds, mostly federal. At the beginning, we also bought some provincial, although those amounts were really quite small. Well, we bought a lot of government bonds. And we did that for 2 reasons. The one is, at the beginning of the crisis, there was a huge dash for cash. Everybody in the financial system wanted cash. They were dumping everything into the market to get cash. And as a result, the system just, it froze. There were way too many buyers and far too few sellers. Sorry, there were way too many sellers and no buyers. So the Bank of Canada had to come in as the buyer of last resort to keep that market open, because if the government bond market closed, the whole corporate bond market is closed too. So nothing gets funded. So the Bank of Canada came in as the buyer of last resort. We then, in the second part, we'd lower our interest rate to effectively 0. We couldn't lower it anymore. So we used buying of government bonds as a way to pull interest rates down further at the yield curve. We couldn't lower our policy rate, but we could lower the interest rates that businesses and households borrow at. I think in retrospect, we should have been clearer about when we were using the tool for one purpose and when we were using it for the other purpose. And we probably should have had some different decision processes to distinguish the two. In fairness, you have to realize that these decisions were taken very rapidly and in a great fog of uncertainty. And certainly, when I look back at that period, you still feel that pit in the bottom of your stomach of just how bad it was. But I think but I do think it's important that you do look back and you learn from these crises. So I think, let's hope this never happens again, but if we do find we need to use these tools again, I think the message is, we're going to be clear on exactly why we're using them. We're going to be clear on under what conditions would you exit from different types of uses, and let the market know up front, here's how we would use it, here's when we would exit, and I think that would be helpful.
Okay, great. Well, I'd like to thank you, and I think everyone, if we can give a big hand, thank you so much for sharing the insights.
Thank you very much for navigating that conversation, Darren. You did a great job. Governor, thank you for coming and addressing the business community here in Vancouver and choosing Vancouver for your year-end address. No question.